Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. What I'd like to talk about here is we get to crunch time at the end of the year and at the turn of the year. You know, the crunch time seems to be sometimes we're overwhelmed with expenses, we're overwhelmed with bills. We don't know what to do with it, we don't know what to do about it, and we don't know how to overcome it. So what I want to help everyone with is let's dig into the finances of how can we get control or get a little better control over paying off our bills or not being really burdened and underwater with all these bills that never seem to go away, keep seeming to get nothing but bigger and keep growing on us and overwhelming us, swallowing us up almost, and we can never get out. So let's talk about that in this show. The bills are normally caused by either choices we've made or through no control of our own circumstances that have come on us, like the holidays. The holidays throw a lot of bills on us that it takes all year sometimes to dig out. So that takes kind of the fun away from the holidays. I wanted to take today's show to help shed light on that there is hope at the end of the tunnel on digging out, even if the bills are overwhelming now. And it may take some time, but let's focus on this. We get all the bills that are accumulated maybe over a number of years with credit cards, or maybe over even just one set of circumstances. So let's work on how to pay down and pay off these bills and not incur maybe extra bills anymore. The first is definitely, if you're not overwhelmed by bills, but you've taken on bills over the holidays and they're within control, the first is establish a budget for next year in little bits, either each pay. Remember the old Christmas funds? They still exist a little bit, but most people don't use them. That's what I'm talking about. How about property taxes? We know property taxes are a major, major expense, and you can't budget for it if your mortgage does not escrow that bill. So for any of you who have paid off your mortgages or who the property taxes are not escrowed, that's a dreadful time of year come September and October when the lump sum property taxes are due, and then again in March for the county. So any bill that you have, we get to a point where what its technical term is a sinking fund. We create a sinking fund to be able to have enough money that by the time that once a year bill comes, that we have the money saved up to be able to pay it. Well, Christmas is one of those. And a lot of us wait until when? Black Friday. And then all of a sudden we go out and spend all this money on charge cards because we didn't save up for it, of course, but these deals and these bargains and these sales are just too good to pass up. And here we maybe even get caught up in the buying season or the sales season and spend more than we thought or more than we wanted to because, well, of course, we simply couldn't pass it up. And then after, January 1st and New Year's comes, we get hit. We get hit then with the headache of, what did we just do? It's the holidays hangover. It's the financial hangover. And it's like, oh my goodness, I can't believe what we did. And now we have to pay for it, right? So it all starts with if we can go back and look at, we didn't crush ourselves in this holiday period, or we did. And then if you didn't, congratulations. And, we'll get to this sinking fund or savings account, Christmas account method of how to not get into it next year and do 1/12 of our Christmas shopping next year. You don't have to do the shopping yet. You just have to set the money aside if you're strong enough to and have the ability to. Remember I said the concept of pay yourself first for your retirement. Well, you could then take the next step after paying yourself first into that account I talked about last week and set aside a Christmas fund, and let's call it that. Christmas is a big expense. You could do the property tax fund, anything that's the lump sum, to try to prevent from having to be really seemingly blindsided when those bills come due, although they were predictable bills. Now, for those of you who went into the quagmire, Black Friday came, you got caught up in the season, you have all these bills now, it's the turn of the year, and we don't want you imprisoned by those bills for the whole rest of next year. So here's what you look at. You look at the bills, you look at the credit cards, you look at where you spent the money, and the first thing we're going to look at is, are the loans or the credit cards or whatever the right place to hold that debt? So you went to some of the department stores or you used a Visa card. And a lot of the times you're using credit cards that give you free points, or if you pay them off within 30 days, you always figure that's smarter than paying cash, which I sometimes find they don't get paid off in 30 days, and now that's where you're holding your debt. So what we want to do is look at the interest rates on the credit cards. If you're holding the debt and now having to pay off the credit cards, I do want you to look at what's the interest rate on the card that you're holding that debt on versus are there credit cards that you could refinance that debt on that would be a lower interest rate or maybe even a 0% rate for 6 months. Now I want you to watch fees because some of these might be deceptively simple, but maybe more expensive or trapping than you had hoped on not being so much 0%. But I do want you to see if you could refinance that credit card debt that you now have at 12% or 21% onto a credit card that might be 0% for a period of time and help you with at least every dollar going toward the payment actually paying off the principal rather than just paying interest. Now, the second thing I want you to look at is this. When a credit card bill comes in, the minimum payment due, if you fall into that trap of making the minimum payment due, that minimum payment is almost always never anything toward any principal. It's almost always interest only. Sometimes not even the full amount of interest. So you might have interest accumulating. Let's say it's a $1,000 bill. You might have a $50 minimum payment, a $30 minimum payment. It might be a $10 minimum payment, but you might see that on that $10 or $20 or $30 minimum payment, that the interest accruing on that is more than the minimum payment. So it might have accrued $25 of interest and the minimum payment might be $20. So you're making the minimum payment thinking you're at least keeping even, and you find you're going further and further into debt. Your account's balance is actually growing with your payment. So watch for that. What you want to do if you have that credit card debt and you have that onerous interest and you cannot find another card to refinance it onto with a lower interest rate and lower fees, at least look at how much is the interest accruing every month and try to make at least that much in interest payment plus some toward the principal, or you won't get that paid off. And what you'll find is you're building up 2 or 3 or 4 years worth of Christmas bills and having to pay that all on the credit card, and you'll never get out of debt. So you want to look at the credit card bills and make sure that your balance is not going up, that your balance with each payment is starting to come down. Then the next thing is you're trying to see, are you having to take on more debt because now these credit card bills are coming onto your other bills and you just don't have enough money to pay them all. So you want to be very careful that you're controlling that debt. So number one, try to refinance at 0%. Number two, try not to buy on credit cards, especially if you think you're not going to pay them off within 30 days. Number three, when you get to these situations, there are loan consolidation strategies that can come into play. Sometimes that's a personal loan instead of a credit card loan. Sometimes that's contacting the bank and saying, I have all these credit cards. Do you have a consolidation loan available, which is a personal loan? It's normally not collateralized, so let me tell you what that means. We own a home, we have a mortgage, the loan interest rate is very low. Some people are tempted to refinance their mortgage to lower the interest rate, which is smart. But some people are tempted to refinance their mortgage and add their credit card debt on top of the new refinanced mortgage amount. So let's say we have a $120,000 mortgage. We have a $175,000 house. We have $20,000 worth of credit cards. Some people will be tempted to say, my $125,000 mortgage plus my $20,000 in credit cards could be refinanced. The bank will give me a loan for $145,000 all on a mortgage at 3% or 4% interest as opposed to 18 or 20% credit cards. Let's refinance it all onto a mortgage. Now here's the problem with that. We've taken short-term debt, which is credit card debt, normally scheduled to be paid off in 3 to 5 years. We've merged it in with a mortgage, and a mortgage is normally 15 or 30 years. So when we've done that, we've stretched that payment out on the credit card for that Christmas for paying it off over 30 years. We've also made the big mistake of freeing up that credit card once we do that, leading to the temptation of the credit card's freed up again, now we can go out and charge again. I know nobody does that, but folks, everybody does that. So that's a very dangerous strategy that backfires. It frequently backfires. So I'm going to caution you on refinancing credit card debt onto a mortgage or refinancing a car loan onto a mortgage. A very dangerous and ill-advised strategy to try to take advantage of. I like better the credit card debt being financed at 0%. There's a great prepayment strategy on working your way out of debt. It is, if you get any extra money, from a tax refund or from a pay raise, to take that extra money, if it's a pay raise, extra monthly or extra pay money, and pay that on top of your payment that you were making on an ongoing basis. In other words, make extra on a credit card loan. What you look at a lot of times is we look at the lowest interest credit card loan. Making an extra payment on that is allowing more toward the principal and gets it paid off faster as one strategy. And then after that card pays down, because we're making that extra payment, that credit card gets paid off. We now take the payment plus that extra we were making on that credit card and put it on the next credit card. And again, the lowest interest payment credit card. Well, now the other strategy is no. You take the highest interest rate credit card and add money onto that first. Now that works when we have a high interest rate credit card And we're trying to pay them off first, obviously, and not pay off the lowest rate. So why the difference? Well, first, sometimes the highest interest credit card, the amount of monthly payment is too high for us to be able to make an extra payment. We're not able to get it paid off fast enough. Where the lowest interest, more is going toward principal. And sometimes you'll see what we're adding to that is almost doubling that payment, paying that off twice as fast. Whereas if we put that on the highest interest credit card, it might have taken it from 7 years to 6 years. So what we want to do is snowball this accumulated debt repayment. We want to accelerate this. So you look at your low interest cards, your medium interest cards, your high interest cards, and you figure out where the money's best spent. I'm going to tell you as a general rule, we want to get the highest interest credit cards paid off first. So that's common sense. But sometimes the method of getting the credit cards paid off fastest is actually accelerating to the lowest interest credit cards and then snowballing up to the highest interest. So there's no hard and fast rule and thumb, but you need to look at both. Again, the core is we want to get those highest interest credit cards paid off first, if we can. And then every time we pay off a card, add those payments onto the next card, on top of the next card. And you can be debt-free in 3 to 5 years in many cases, just using that payment strategy. And then we get to working on paying extra toward the mortgage. But the mortgage should be the last one you're making those extra payments on, not the first one. Remember, the interest on mortgages currently under current tax law is tax deductible. We may keep that tax deduction, but it may become meaningless if we can't itemize property taxes and a lot of other things. Will never exceed the standard deduction. So we may not have the mortgage interest tax deductible, even though it is. But it's still the lowest interest rate you're going to have. Now let's get back to this loan consolidation. Away from the credit cards. We have all these credit cards built up, and we say, can't we consolidate these loans? Now we're talking about a personal loan usually. Keep it away from that home mortgage as I talked about. But a personal loan is normally uncollateralized. Remember I said collateralized and uncollateralized. The loan mortgage that means if you don't make that payment, they get to take the home and by foreclosure. That means that loan in a mortgage is using the home as collateral for the bank's assurance that if you don't pay, they have some asset they can come and take. A car loan is collateralized by the car, that if you don't make the car loan, they can come and take the car, which is collateral they are holding as security for that loan. Now, a personal loan is typically with that same bank, not collateralized. It's a personal obligation that's typically not collateralized, but you're personally guaranteeing those loans. So that still means they can come after your personal, they can make a filing against you and come after your personal assets because you're personal guaranteeing that loan. But it's not directly collateralized by any individual asset. So it's an uncollateralized personal loan. Credit cards are uncollateralized also. Now, a personal loan with a bank, normally a lower interest rate than a credit card loan. Not always. Like I said, you can have a credit card at 0%. That's a lower rate than you're going to get with a personal loan. So what we do with this loan consolidation is figure out how to dig out of debt the best way. Well, number one is pay 0% interest, because then every dollar of every payment is going to pay down the loan. Number two is don't take on any more loans. Don't take on any more credit cards or personal loans. Shrink your budget. Live within your means. And then for all the debt that's accumulated, any payment is truly being paid down that won't reoccur because you're not charging anymore. I know that's like going on a financial diet because it is, but it's how to get out of debt and it's how to pay down your debt. So you take any extra payments that you get for a year or a couple years, that is money coming back on your taxes, pay raises, something happening that maybe you're getting money back for things, that is where to use this money and pile it into those loans, those credit card loans. So you get to the 0% credit card, you do the personal loans through the banks, the consolidation loans, and then you tighten the budget and you begin working down that debt. You will get your debt paid off bit by bit, and with each one that pays off, you then have more money building, snowballing actually, to accelerate paying off the other debt. And it will work. It will work, and it does work. Now, then we get to budgeting so we don't get into debt again. That is setting up monthly or by pay savings accounts, those sinking funds I talked about, savings accounts that you're beginning to save money. So when Black Friday deals come, you have a Christmas budget that you know, here's how much Christmas is going to cost us, whether we prepare for it or not. Here's how much property taxes are going to cost us, whether we prepare for it or not, right? Some people take a withholding, a higher withholding out of their pays and to get a bigger tax refund. But they know they're not going to spend the tax refund, which is the hard part, by the way. They just know that's the best forced savings program they know how to do because they know if I save money, I'm going to spend it. I'm going to go into the account. I'm going to find that I need it, many people will say. So they can't save money. So what they'll do is they'll increase their withholding at their employers. They'll say, take out more from my pay. And then they know at the end of the year, they're getting a refund, but they then plunk that money into a savings account or pay off that bill or whatever it is that they know they're not going into debt. Normally, the smartest thing to do with that sometimes is when the tax refund comes, set it aside into an investment account somewhere elsewhere, somewhere other than local bank savings account, because then it's hands off and it's toward their retirement. And they're actually using that as a savings account toward a retirement contribution. Now, what possible retirement contribution could a tax refund help? Boy, does IRA come to mind? Because an IRA contribution is tax deductible. So what if you took your tax refunds every year, put it into an IRA contribution, which is tax deductible for the next year? That's a pretty great strategy, right? Your tax refund comes after tax season, and you use it for an IRA contribution, a tax deductible IRA contribution for the following year. So that money's being invested and invested and invested, and you're increasing your withholding to help promote your savings for the future. So there are a lot of ways to do this, a lot of ways to pay off bills, a lot of ways to strategize this. But what you want to do is sit and look at your bills, look at what's causing your bills, these Christmas expenses that just came. I hope these are some strategies to help you with how do I get these paid off. Look at the refinancing of credit cards to go to 0%. Look at adding a little bit extra onto every credit card payment to start paying them down. Look at the minimum payment of these credit cards. Make sure, are we paying at least more than just the interest? Or else we have an eternal loan that will never get paid off. Look at, should we do a consolidation loan? And then look at paying extra toward each one of those loans, getting them paid off only one at a time. And then once that's paid off, taking that whole amount of payment, adding it on top of the next loan that you want to pay off. And the snowball effect of paying off all the loans over a much shorter period of time, getting you financially free. And then finally, saving monthly every year toward next year's Christmas and the years after that. So Christmas is no longer a financial burden. Think those Christmas accounts and activate those, get them started so you never go into debt again. All right, folks, I appreciate you tuning in to another edition of All Things Financial. We'll be back again next week.